So this leads to the next big question. What type of life insurance should I buy for my family?
Yeah, and so when we think about life insurance, there are really predominantly two types. Even though they get packaged a number of different ways, there are two main types of insurance. The first is just called term insurance, and the second is called permanent insurance. And they sound exactly like what their name suggests. Term life insurance offers pure insurance coverage for a specific period of time, whereas permanent life insurance, the intent behind that is that it will be in place for the remainder of your life. So one is temporal or temporary, that's the term, and one is permanent, planned on being there. When you pass away, the insurance policy will pay out.
Now, I'm going to play devil's advocate because I know if I'm a person that sells life insurance, I'm going to take advantage of this stat I heard that 99% of term life insurance doesn't pay out.
Yeah, it expires worthless.
So aren't we in effect, if 99% of policies that are written that are term-based don't actually get paid out, isn't that just throwing money away, Bo?
Well, I guess technically, yes. If you think about it in that sense, from an ROI sense, yes, I'm spending money on something that I hope I never use, and I hope I never have to capitalize on. And yet, think about like logically how that plays out. Hey, I spent money on this term for 10 years, 15 years, 20 years, and guess what? I didn't die. That's a reason enough to celebrate.
That's actually a good thing.
It's okay to technically throw that money away because it did serve a purpose, even though you didn't receive a benefit from that life insurance.
Well, in a lot of ways, this is where it is somewhat similar to like when you insure items that you own, like a house or a car. I don't actually get frustrated that I didn't have a car accident last year. Actually, it's
super happy about
I paid an insurance premium on that, but I'm glad that nobody in my family got in a car accident and actually needed to go replace a vehicle or something like that. So I think you're right about that. But it is one of those things. I want to build this foundation out a little bit more so people understand what they're dealing with. Term, since it's a period certain, because typically you see like 10-year term, meaning the premiums are level for 10 years, 20-year term, 30-year term, they do expire.
Yep.
So that probably means there's going to be a cost component, because if one is permanent and one goes away, how are these things structured from what I got to pay to get the same type of coverage?
All else equal, you'd probably say, no, I want the permanent stuff, right? Like I want to make sure that's there if all else was equal. But unfortunately, all else is not equal, because when you look at the cost of these two types of insurance, they are vastly different. Look at this. Now, we're just looking at a specific type of permanent life insurance called whole life insurance for this example. But look at what the annual rates of this insurance is for a healthy female in excellent health if she wants to have a $500,000 death benefit for a 30-year-old. She can go out and buy a term policy at 30 years old for $188 to have $500,000 of coverage in place. If instead, though, she wanted to go buy that same amount of coverage, but buy a permanent life insurance policy, a whole life policy, she's going to spend over $4,000 a year for the exact same amount of coverage.
No, there's a difference. Typically with a term policy, like on a 30-year-old like this would be for a 20-year level period.
Yep.
Now, look, if you have a child that was just born when this person was like 28 years old, and now by the time this person gets to 50 years of age, that child will probably be graduated college, and hopefully they'll be financially independent. It will be completely fine that this insurance goes away. But I got to tell you, this is the thing that when I see the pricing, because when you look at 30-year-olds, 40-year-olds, it is like a 20-fold difference in what the annual premium. And I just know when I was in the messy middle, I had, it seemed like everything in the world was trying to get to my back pocket. You know, whether the kids, me trying to save for retirement, there's just so many things going on. The fact that if I had to save $4,000 a year to pay my life insurance premium versus $188, I don't think I could do it. So I would just be sitting there naked on the exposure to my family, whereas at least term allows me to cover the need, but then invest some of that money above and beyond that for the future so I can actually build financial independence above and beyond.
Yeah, but see, that's where the salesmen get you. That's where they kind of wrap this up as a different thing. Okay, no, you don't have to just let your life insurance be this thing that you're throwing money away on. It can actually be a wealth generation tool for you. We're going to pitch it as a way where not only can you buy the life insurance covers, but we're going to have those dollars grow. We're going to have those dollars be invested. We're going to have those dollars pay a dividend. But we think, our opinion is, your strategy that you just said makes a lot more sense. We want our insurance products to be insurance. We want our investment products to be investments. Because what we find is when we mix those together and we have them serve a dual purpose, neither of those purposes are optimized, and we think that it's not the best solution. There's a few different reasons why we say that.
Now, wait a minute. I want to stop you because, look, we don't sell life insurance. So I think if I was an insurance professional, I'd be like, well, these guys, they're going to just try to push you towards something that they deal with versus what we deal. But don't take our word for it. Daniel in the notes, and you can do your own research on this. Consumer Reports had an entire write-up on whole life insurance. Mm-hmm. Is it right for you? And you can go do your own Google due diligence on this. But from their findings, they found that this more conservative type of investment or thing that you're buying to provide coverage that we already shown is 20 times the cost of term is only typically providing a rate of return between 1.5% to 3.5% per year on average.
And that's on average after all the fees and all the expenses, because what you often get pitched on, there's this guarantee, there's this dividend rate, there's this rate of return that you're going to receive on this if you're talking specifically about whole life, on this whole life policy. However, one of the things that's really, really interesting is that guaranteed rate of return. You would think, as we've moved into this environment where interest rates have gone up and cash a couple of years ago was paying nothing, but now we're seeing cash paying rates as high as like 4.5%. You would think that the dividend rates on those whole life insurance policies would have been the same. They haven't. They've actually stayed flat or actually decreased slightly. So these dividends, this guaranteed return, doesn't necessarily move with interest rates. So if we do enter into a time period where we have really high inflation, like we've seen over this past couple of years, these policies, often the growth rate that's embedded in them, even if you were getting the full dividend rate, not factoring in the fees and expenses, wouldn't even keep up with higher levels of inflation.
But maybe we're looking at this wrong. Maybe the guaranteed type of product is not right. That's your whole life. What if we transition to maybe a variable life insurance policy? Because there's even products, because these insurance companies are no fools. They've actually structured products that actually allow you to have some component to participate in what's going on in the stock market. What's the issues with that?
Yeah, so a lot of times what they'll do is say, okay, great, you can invest these dollars. And then what we're going to do, though, is we're going to put some caps on them, or we're going to make you subscribe to a capture ratio. So maybe if you invest and you are going to, in the market, you want to peg it to some specific market benchmark, rather than you getting all of that uptick, you're only going to get a portion of it. So maybe you're going to have a rate cap that if the market makes 15%, 20% in a given year, you might actually only be capped at 7% rate of return. Well, what do you think that the insurance companies are doing with these dollars? They're taking these dollars and investing the same way as you could on your own, except for they're keeping the amounts above and beyond those rate caps. So they are actually handcuffing what these policies can return over the long term.
Well, what I don't love about life insurance as an investment is you're going to figure out a whole cadre of words like surrender period, a deferral period where you're not actually allowed to pull out more than 10% of the cash value of policies. Just be careful, because there are a lot of restrictions. Because remember, to offer guarantees or even to offer participation in the markets, there has to be a catch.
That's right.
Because they have to control your behavior. And a lot of times the catch on like the withdrawal on the guaranteed products is going to be your inability to pull the money out. So they have enough time to spread out the risk. On the variable products, they're going to catch you on the fine print, like they're going to take away the dividends,
it's
the
huge.
S&P 500. They might show the performance, but they don't get to count the dividends and other participating factors, or they'll cap the performance. So if you have the years, like you shared, where the market makes 20% and you're capped at 7 to 9%, that is tremendous in the long term. So just don't fall prey to this. And this is a challenge that I have. There is no doubt that there are very wealthy families that do use insurance as a tool.
Sure.
However, I am still waiting when we do our annual wealth study of all of our millionaire clients. I don't have any of my millionaires who have said that the reason that they're a millionaire is because of this great insurance product that got them there. It is typically a tool that the ultra wealthy use to kind of expand or protect their wealth. It's not the tool that got them to wealth. That's just my experience. I'm sure there's going to be insurance agents and others that will say it. And I love insurance. If you looked at how I've structured my financial life, I am insured up to my eyeballs. However, it is one of those things where I have not used insurance to try to be the wealth builder because I just don't think that that is the most efficient path with all the fees, all the restrictions. There is a much better way, but that doesn't mean you should ignore what value that life insurance can provide for your family.